When we hear the term renewable resource used, we often refer to things like energy, such as solar or wind. Most prudent people would agree that the practical use of renewable energy is ideal. We all can see the benefit of planning ahead so that we never run out of something so important. So when it comes to investing for income, informed people are employing the same concept. They use their accumulated savings to create an ongoing income stream while leaving their principal intact. As life expectancies continue to increase, it becomes more important than ever to have a semi-passive engine routinely providing fresh cash to meet living expenses. There are many aspects of income-based investing that make it a practical choice for investors in or near retirement, including risk reduction. It's almost as if a light bulb turns on as investors realize that increasing their income doesn't require increasing investment risk, but just the opposite. One of the more popular misconceptions is understanding the difference between growth and total return. Many on Wall Street use these terms synonymously, and advisors with stock-based business models believe that investing for growth is the only way to get a reasonable return on investments. Return, or total return, actually stems from two components: income and growth. In other words, total return equals income plus growth. It's important to understand that the income portion of total return comes in the form of both interest and dividends, while growth is simply measured in capital appreciation. You may have been taught that in order to increase your returns, you must increase the growth, and that the best way to do so is through traditional buy and hold investing in the stock market. Thus, many people have the idea that increased income requires increased risk. That's wrong for two reasons. First, the G, or growth, can quickly turn into an L, or loss, when the stock market suffers a major downturn, like the ones that began in 2000 and in 2007. And second, when you invest for the I, or income, instead of the G, you're typically investing in vehicles designed to significantly reduce volatility. This isn't to say you must sacrifice growth when you shift your focus to income. You can continue to grow your portfolio organically by strategically reinvesting the income you don't need into other, more conservative vehicles. If you retired in 2000 and tried to engineer income through growth, you would have experienced 13 years where the stock market was underwater and didn't experience any growth at all. Therefore, you wouldn't be able to get income since you were investing for growth, or you would have to spend down your principal, knowing what a slippery slope that can be. For example, if you opted to spend down principal and started with $1 million in the year 2000 and took out $40,000 per year, at the end of 13 years, you would only be left with a little more than $500,000. The withdrawal method. Returns calculated using month-end price of the SPTR index published by CBOE. Many income-based investors whose portfolios have been properly managed can take comfort in knowing that they can get close to 4% or 5% in income from their assets on an annual basis through dividend-paying stocks or bonds and bond-like instruments.